Welcome to the Well Off Podcast, where the goal is to motivate, inspire, and share success principles. I'm your host, George Almasri. Dalia Barsoum is the founder of Streetwise Wealth, a boutique real estate wealth advisory firm, and Streetwise Mortgages, a multi-award-winning brokerage specializing in income property financing. The team at Streetwise has funded over $1 billion of mortgage volume and over 2,700 mortgage transactions ranging from residential, multifamily, mixed use, and other construction projects. On this episode, we discuss rising rates, where we're headed, how investors can address tighter cash flow numbers, the importance of having an exit strategy when investing in real estate, and why you should use a mortgage broker on commercial multifamily deals. And I hope you guys will enjoy the episode. I always ask you guys to leave a review. That's much appreciated on iTunes or the Apple Podcast platform, I should say. And I have this really cool report for anyone that's interested in investing in multi-units. So the report is called Multi-Unit Renovation Operations Order, a guide to starting a renovation. I think this is going to be really useful to some people that are maybe starting out doing their first couple multi-unit renovations. You can download it by going to www.welloff.ca/report. And there's a couple other things you can download there. So there you go. Enjoy the episode. I'm here with Dalia Barsoum. This is the second time we record. I don't know if you remember, but the first time, I believe you rented a room, like a conference room at a hotel, because I don't remember why that happened, but that was the first time we recorded.
That's right.
We had a whole big conference room to record.
Yes, and now we're in your office.
Yeah, yes. Exactly. Well, thanks for joining me today. We had a couple things that we want to talk about. So today is June 7th. By the time this comes out, it'll probably be in July. But there was an interest rate announcement today. Mm-hmm. We saw an increase of 25 basis points.
Yes, that's right. Yep.
So why don't we just kind of dive into that a little bit and see what are your thoughts on what happened and where we're headed?
So the last gesture by the Bank of Canada was around pausing the hikes. However, there is always a qualifier, right? And it's about the data. If we don't see core inflation, the core CPI coming down as per their expectation, the unemployment, coming down, inflation cooling off, they always have a qualifier that we're prepared to raise the rates, which they did refer to previously. And here we are. The data didn't, support a continued pause or even easing up. It's basically indicating that the economy is still hot despite the hikes and the tighter monetary policy. So the bank wants to obviously act and not just sit on that, and therefore the decision today to increase. And now the market is expecting another increase in July and another one in December. So not the news that anybody was hoping for, especially that I think the community got a little comfortable with the fact that there was a pause for several months. So again, it's all about the data. And if the data is not heading in the right direction, the bank is going to take measures, and that's what the role is, and that's what they did today.
Well, just from my perspective, being involved in real estate sales, although I'm not as active as I used to be, my wife is a realtor. Any listings we've had in the last couple of weeks have had multiple offers. We set them up that way where we price them a bit low, hold offers, and we got like tons of offers on a bunch of our listings.
Yes. And
they're just selling like crazy. And it's just weird to see that, considering prime rate is at 6.7. Now, I guess prime is just under 7%, right?
Yes. Well, it was 6.7, now at 25 points to that. On the multiple offers front, George, yes, we're absolutely seeing activity. It's not like everyone is sitting on the sidelines waiting for the rates to come down. There is an opportunity cost for not owning a property, and for investors, if the numbers work, they work, right? So we're seeing multiple offers all over again, and we're seeing firm offers all over again.
Yep.
Yeah, and I think the market adjusts over time to the new rate norms. And it's also a numbers game. If someone can afford it, they'll buy because there is value in ownership. And if someone is going to make money, it's just the cost of money. And if the numbers work, they work. So we shouldn't, as much as there is that disappointment in the fact that there is another rate increase, and it's definitely adding pressure on cash flow. I mean, we work with a lot of investors, and those who are on adjustable rates or variable rates where the banks are adjusting the payments or coming out of a previous rate to a new environment are feeling the crunch on cash flow. And there are solutions, but it is a temporary transition that the market is going through, and eventually the rates will come down sometime in 2024.
Now, what do you suggest doing if you are an investor? You had, your numbers based on 2022 rates, which were in the 2% range, or maybe potentially in the low threes. Now, all of a sudden, your variable, so you're all the way up to like say 5, 6, 7%.
Yes.
Your cash flow went from positive to potentially negative.
Yes.
What do you think investors should do in that scenario?
There are a couple of options. So the easiest option, I would say, to call the bank and say, hey, can you extend my amortization? There has been an expectation that we're going to see mortgage defaults rise and people selling properties, and that's not happening. And it's not happening because the banks are allowing extended amortizations. There are amortizations that we're seeing at 70 years right now with some lenders where clients have a variable mortgage where their payment has not increased, but their amortization extended, and some banks are letting it ride.
Yeah.
So in some cases, for clients who are on an adjustable rate mortgage, which is the type of mortgage that fluctuates as prime changes, call your bank and see if they would extend the amortization. And what I have experienced with some clients is that some banks are saying, yeah, we will extend it without doing a full qualification or anything. So that's option number one, because extending the amortization will ease up the cash flow pressure. That's option number one. Option number two is to consider a refinance to a lower interest rate lender with an extended amortization, which we can look at, but it does require full qualification. Like right now, for example, we work with HSBC, one of the lowest rate players on the street, and we've had clients switch from other lenders to HSBC and extend the amortization. That's option number two. Option number three is to go on an interest-only payment. So the way you do that is if we can revisit the mortgage structure, and again, this is a refinance, and see if we can have a component as a line of credit and a component as principal and interest payment, then an interest-only payment, as much as it's an interest payment and the rate could be higher, is easier on the pocket sometimes compared to a principal and interest payment. So that, again, alleviates the pressure. And then the last solution is let's look at your big financial picture and see where are you paying money. Is there a place where we can reduce a payment here to create some breathing room there?
Yeah, like if let's say you have one property that's underwater every month.
Yes.
But you have another one that's cash flowing significantly. Can you offset it somehow, right?
Yes, that's a fifth way, actually. But what I was referring to is more on the debt side. So let's say you have a car payment, and that car payment is $1,500 a month. And that car payment may be a zero interest or a low interest payment, but it's costing you a high fixed payment. Can we clear that off with some debt consolidation? So now it frees $1,500 off your balance sheet. And now, you're ahead by $1,500 in a way. That's the idea behind it.
Got it. Yeah. Just to go back to that line of credit strategy. So if you were to do that, let's say you wanted to refinance, get a home equity line of credit, are you able to get a home equity line of credit to cover the entire existing mortgage, or
up to 65% of the value? So a minimum 15% has to be in a mortgage.
Right. So you'd get 15% mortgage, 65% home equity line of credit, and you would have 20% equity in the property. That would be a lower payment than having a full mortgage because the mortgage is principal and interest. The line of credit's interest only.
Interest only.
Yeah,
Exactly.
so you're not getting ahead in terms of mortgage pay down that way. But if you're bleeding every month and you need to stop that, then that could be an option.
Yeah, the goal right now is to ride the wave, right? Obviously, if you can ride this wave and continue to pay your principal and interest and pay down the mortgage, fantastic. But if you cannot ride the wave, we have to look at ways on how we're going to ride the wave. So the priority shifts from let me pay this mortgage as fast as I can or continue to make principal payments to let me make sure I'm covering my expenses and the property is carrying, and then we revisit when the rates start to come down in 2024, which they will. When exactly, nobody really knows, but the market is expecting it to happen sometime, end of Q2 or early Q3.
Yeah, it's interesting because a few months ago, everybody was projecting that the rates would come
Not
down this year.
Yeah.
And even you saw fixed rates were coming down. I guess they were because of that anticipation. But now the expectations have changed. Now they're saying, oh, hold on, we're going to probably raise rates some more this year. Mm-hmm. Yeah, so things change really fast.
Yeah, it's been very volatile. Mm-hmm. Yeah.
Why don't we shift things a little bit more to the multifamily financing? So you were just a sponsor at the multifamily conference. I saw you there.
Yes, I spoke,
a lot of people at that event. Seems like a lot of investors are starting to focus on that strategy. Mm-hmm. Just out of curiosity, how much of an uptick have you seen in people interested in commercial multifamily and actually doing it?
I have seen a huge interest in multifamily. Many investors are looking at 5+ units, and it's for a reason. It's because the cost of money in the multifamily space is still lower than the cost of money in the residential space. And obviously, with more units, that numbers can play out better. And then there is the CMHC MLI Select program that came into effect almost more than a year now, that offers investors a higher loan to value and better rates and extended amortization. So all of this is sparking a lot of interest in the multifamily space. So there's a lot of talk about it. Actioning it, I would say out of 10 investors, I'm seeing maybe 4 actually do something with this information and move forward with it. I think part of it is that some investors still find it overwhelming to step into multifamily. Mm-hmm. And it's taking them a little bit of time to understand what it's really all about, how to make money, because it's not just as simple as buy it turnkey and it's going to cash flow, right? Yeah. There is some renovations and flavors of renovations involved to increase the NOI and deal with tenants. Exactly.
Right, turning over the units.
Exactly.
Providing incentive or whatever to the tenants.
Yeah.
It's a little bit more challenging than that, vacant single family home or bungalow that you're turning to a duplex.
Yes. Yes. But once you crack that shell, even if you crack it through a 5 units or a 6 units, you get the gist of it, and then it becomes, just a rinse and repeat.
Sure.
It's the same idea.
Yeah. Now, for the people that are interested in getting into commercial multifamily, as part of the due diligence, obviously you have to have an exit strategy, right? So a lot of times what people do is they get a bridge loan to start, or a VTB, or a vendor take-back mortgage, or private financing or something, and then they'll look to exit by refinancing through CMHC. Would you agree with that?
Yes, 100%. And I love the fact that you're commenting on the exit, because I have seen investors focus primarily on how they're going to acquire the building and obviously how they're going to renovate it, and then make assumptions around how the exit is going to fall in place. Oh, we will be able to refinance at this and get this much at this cost. And then fast forward, that may not happen because they have not validated these assumptions up front. So to your point, we always start with the exit. Okay, you're buying a building. What are you going to do with it? Let's look at what is it going to potentially look like 18 months out or 24 months out. Let's validate how much will you get with CMHC or conventional financing, and then work backwards towards how we're going to acquire it and renovate it, which is then where you use a combination of tools. Could be a vendor take-back, private money. Some investors use promissory notes, bridge financing, other people's money, which is equity partners. And that's how we say, okay, let's now reverse engineer, right? So this way, you are acquiring it with the combination of tools that make sense to you as an investor, given where you are on your journey and the resources available to you. But also we know that we're going to be able to exit.
Sure.
Because I've come across several investors who've come to us stuck after the fact. They're like, Dalia, okay, I took this much in construction financing. I thought I'm going to get this much on exit. And now I cannot pay it all off. What do I do? Mm-hmm. You don't want to be in that situation.
Yeah. And if that does happen, like, can you give us some examples of what people have done to get out of that situation? I don't know, maybe they're forced to sell, or...
There are different routes that we look at before, obviously considering selling. Someone worked so hard to get the building to that stage, they don't want to sell it. So money partners is one option, bring in equity partners in. So let's say an investor renovated a building and now it's worth $5 million and they can qualify for, I don't know, a $4 million loan. But they took a much bigger loan initially to acquire it and renovate it, and maybe the renovations ran over cost and things took longer. We know how things were during the pandemic, right?
Yep.
So there is a shortage now at exit. Let's say it's $500,000. What do you do as an investor? Well, money partners is an option. Bring in an equity partner for that $500,000. That's one option, but you're going to give them a piece of the pie. Mm-hmm. Another option is for us to see if we can consider money partners' money, but also maybe raise capital from the rest of your portfolio. There are lenders that will allow a second mortgage behind them. Maybe we can keep a piece of that in a second mortgage. So the combination of these things typically is what we lean on.
Mm-hmm. Right. Yeah. I think that's so important when it comes to commercial multifamily, because if you assume things, you do your own underwriting and you assume you're going to get a certain amount, like you said, when you exit, but you're off, then that could be very costly, because you're not necessarily dealing with $20,000-$30,000. You're talking about a few $100,000
Yes.
potentially, or more.
Yes.
So it's not as easy to come up with that kind of money.
Yes.
Yeah. So
you're right.
I think one thing you were just telling me before we got started was to get an appraisal done, and you asked them to do an as complete appraisal, right? So
Yes.
What's the price once we turn over these units? What's the value going to be of this building? And that way, at least for yourself, this is how much I should be able to get out of it, right?
Yes. So for investors who typically consider creative financing to acquire the building, vendor take back, other people's money, private money, you're not really dealing with a traditional lender, right? So yes, you're going to do an appraisal because you want to know how much you're paying for the building and validate that, right? But it is very, very, very unlikely that someone is going to say, George, go and do an as complete appraisal, because they don't need it unless you're getting construction financing or renovations money. But for every investor who's going to reposition an apartment building by renovating and is planning on increasing the rents and the value, do it for yourself so that you know what that end picture is going to look like. And that appraiser then validates your assumptions going into the deal.
Sure.
And then your broker can, also help you understand what is the CMHC loan going to look like, or the conventional loan going to look like based on these numbers.
Right. Yeah, so
that's part of the diligence.
For sure. So you get your appraiser to give you an as complete appraisal, but you also reach out to your mortgage broker and say, how much will I be able to take out
Yes.
if I get the NOI, net operating income, to this number?
Yes, exactly.
Right? So
exactly.
Yeah, so you kind of make sure you cover yourself on all ends, because you don't want to get stuck, like you said, at the end, right?
Yes, exactly.
Can we talk a little bit about you working with a broker on the commercial side with commercial multifamily? Obviously, we know the benefits of working with a broker on the residential side.
Yes.
But maybe it's not as clear on the commercial. So let's talk a little bit about that.
The benefit of working with a broker who is experienced with commercial financing is the fact that they can help you strategize how you're going to acquire, renovate, and exit the deal using the different money strategies. When you talk to the lender alone, they're thinking about their products and what they can just offer you. In the multifamily conference, I talked about 6 money strategies: promissory notes, private money, vendor take-backs, bridge financing, traditional mortgages, and other people's money. These are the 6 money strategies for apartment building investors. If you're to go to the lender directly, they're just in that traditional money tool space. They're going to think that way. They're going to say, here is what you can do based on what we know, what's on our shelf. When you go to a broker, they're now looking at the 6 tools for you, and they're saying, okay, here is what you want to do. It makes sense to use this tool now and use this tool later. And here is the best way to structure it. You're not going to get that comprehensive money strategy from one channel. And that's the value of working with a broker. And then obviously the broker who has relationships in the commercial market can also get you a better deal. Like, for example, we have what's called a direct correspondence with CMHC. And that allows us to speak with CMHC directly, get better pricing because we're doing a lot of the heavy lifting on behalf of the lender. And once we get that certificate at hand, that's very attractive for lenders to start to bid on, to offer you as a client a better deal. So that's the benefit in the commercial world.
What's that certificate called?
The certificate of insurance.
Okay.
That's the CMHC equivalent of their commitment, mortgage approval.
Right. So you get that document by basically preparing everything for the lender, and then you shop it around to different lenders and say, hey, this is the deal. This is what it looks like. Who wants this, right?
So we speak directly with CMHC. We structure the deal. We defend the deal. Sometimes we have to ask CMHC to use to invite them to use different reserves than what they're using because there is a story, there is context. And then when we get that certificate, we now can go to any lender and say, we've got the certificate, we've done the heavy lifting. How much, premium, Mr. Lender, are you going to add to this rate to offer to our client? Because that's where the lender's margin is. They add a premium to the rate to basically that becomes your final rate.
Sure. Now that CMHC rate that's on that sheet that you discussed, does that vary case by case, or is it just based on like the bond rate?
It's based on the bond yield.
Bond yield.
Yeah. But with CMHC, you have 5-year pricing, 5-year fixed and 10-year fixed.
Yeah.
These are the 2 options.
Okay. Now, would you say it's risky for an investor to rely on a CMHC exit? Because I don't know if there's, they're going to reject it for some reason. Maybe it's the loan amount, maybe it's the location, maybe it's other factors. Just curious on your take.
That's where experience comes in, okay? So not every deal is a deal you can exit with CMHC. For example, if you have a mixed-use building with a commercial space greater than 30% of the square footage or the value of that space is greater, that's not a CMHC deal. If the project is good, but the borrowers on the project cannot fulfill the criteria CMHC is looking for, that's not going to be a CMHC exit unless we address these gaps ahead of time. So to mitigate this risk, experience of working with a broker who knows the rules is key, but also one way to mitigate that risk of exiting with CMHC is to see if we can structure the deal to acquire the building and to renovate it with what's called bridge financing. So basically you get a bundle loan, one to acquire the building, maybe 75%, and then one to renovate it that can go up to 100% with a CMHC approved lender from the get-go. What that does is that lender is not going to give you this money unless they have a very high degree of confidence that CMHC is going to pay them off. So they're taking on that risk versus you. So that's one way to mitigate.
Choosing the right mortgage product isn't always about the lowest interest rate. My name is Don Chen, mortgage agent with Pineapple Financial. And here are the 2 things you need to keep in mind. First, exit cost. Does your mortgage product incur a high penalty cost when you need to refinance or make any adjustments to your mortgage, or if you need to sell your property? Secondly, equity accessibility. If you need to access equity that has been built up, does your mortgage product allow you to do that freely and also in the most cost-effective manner? These 2 things will put the most amount of dollars in your pocket and help you get ready for your next real estate project. I would love to connect with you for all your mortgage-related questions. You can reach me at 647-961-3281, or you can find me on Instagram and Facebook at The Mortgage Dawn.
What kind of rates are we talking, though, in that scenario? Is it like, are we talking about the high close to 10% sort of rate, or would it be somewhere in the middle?
These are interest-only loans, generally at prime plus 1.75 to prime plus 3.
For
interest
the,
only.
For the main loan, or for the main loan
Both.
and the construction
Both.
loan as well? Yeah.
Both.
Yeah.
So they're both interest-only loans, one to acquire and one to renovate, fully open. They can go up to 36 months with an exit to CMHC to pay it off
Got it.
and convert it into long-term financing.
Sorry, that was strategy 1, and then I cut you off for the
No.
second option.
We're talking about the same thing.
Okay. Yeah. So let's just say for some reason CMHC rejects it and says, nope, we're not gonna fund or insure this deal. What would you recommend doing in that scenario?
We have to look for alternatives, and the alternatives are conventional money, which gets you a loan up to 25-year AM, but typically the loan amount is less than what you would get with CMHC. Or alternative money, and that's quote-unquote B lenders' money. They go up to 30-year amortization, and they do things that are more lenient compared to the conventional lenders. But what's going to happen in that situation is you're very likely going to run into a shortage that we'll have to cover through another venue, right? Because CMHC can get you typically the biggest loan because of the extended amortization and the loan to values and the ratios. So if we cannot go there, we have only these two other options.
And that's a big problem right now because the rate's so high. So if you're relying on CMHC, you're going to get it potentially 40-year AM or I don't know, I guess longer with the MLI Select program.
Up to 50 with MLI.
Up to 50 years. And then you have probably the best rates you can get. On the commercial side, if you can't get that, now you're stuck with a 25-year AM and a higher rate. That's you're likely going to be in trouble, right?
It will definitely impact your cash flow and how much equity you will take out.
Yeah. So, like you said, to mitigate that, you got to have a plan right from the start.
From the start.
I guess like in a scenario where you are getting a VTB on the mortgage, you can't go from a VTB straight to a CMHC program, right? You have to do, I guess, a temporary bridge loan just before in order to get there, right?
That's right, because CMHC now pays off lenders who are on their approved list. If you Google CMHC's approved lenders, you'll see that list. So anyone that is not on that list is not getting paid out through a straight transition. We have to take that temporary step before we go there.
And obviously there's a cost associated with doing that, but it's the cost of doing business.
Yes.
Do all the major lenders offer, I guess, loans through CMHC, like an insured loan through CMHC?
No.
So on the residential side, the big banks, those are not going to offer the same types of options on the commercial side.
Not necessarily. Yeah, exactly.
Okay.
Not necessarily. A bank may have a CMHC route or an insured route on the residential, but not necessarily on the commercial front.
Right.
The lenders pick and choose where they want to play. And the margins for lenders on CMHC loans are smaller than their own internal conventional loans.
Sure. I don't know if you're able to share this, but can you share some of the lenders that offer CMHC mortgages?
Yes,
insured
absolutely.
mortgages?
Yes. So you've got Peak Hill Capital, CMLS, First National, MCAP. These are the four primary ones.
And I've from what I've heard, I believe that First National has like a huge piece of the pie on
They
that
do.
end.
Yes.
Do you know why they're doing so well on the commercial multifamily space?
I mean, they have a great team, and they've been around for a long time, and they deliver. So, that's part of it too.
Okay. Any other tips for people? I'm sure you're getting tons of messages and emails and calls having hosted at the commercial, the multifamily conference or being one of the sponsors. Any other tips that you have for people that are just getting in, or maybe they're buying their second building or something like that?
I would say it's important to learn from someone who's done it before. What are you about to step into? Like, obviously, you need to learn what the strategy is all about and how to mitigate your risk of stepping into that strategy. And then you want to have, I want to say control, but you want to pay attention to who is on your renovations team, because I see that as one of the things that go sideways with investors who are buying apartment buildings. When they're renovating, the renovation could take longer, the renovation can cost more, the contractor doesn't show up. So you want to figure out how you're going to mitigate that risk. And obviously on the financing front is where we help investors mitigate what we call the money setbacks during apartment buildings investing.
That makes me think of something else, actually. When it comes to the financing side, off the bat, some people will get VTB in second position.
Yes.
So let's say they'll do, I don't know, like a 20% loan to value VTB in second.
Yes.
And then they'll go with a CMHC first up to, I guess it would be, 85% total loan to value?
Yes. So under their conventional program, you can put a VTB second up to 90% of the value. I've seen 100% VTB second, but only behind a private first mortgage.
Right. Yeah. And would that be, I guess, any lender under the four that you mentioned earlier? Would all of them accept that, having a VTB in second?
No, not all lenders do. So there are two things when it comes to VTBs. Some lenders will not accept it regardless. And then the lenders who do, they want to see that the property can support the VTB payment in addition to the first mortgage payment, meaning that the debt coverage has to account for both of these payments.
Yeah.
So I've seen some investors, for example, go and negotiate a vendor take back, and the seller wants to give them $400,000. And then we're running the numbers, and they're taking a traditional mortgage with a lender that allows a VTB second. Great. But the property cannot support the payment on the first mortgage and that $400,000. So they either have to go back and negotiate a different payment, and we guide them as to what that needs to be and see if they can negotiate it, or they'll have to cut down the vendor take back to make the numbers work.
Yeah.
So the fact that you can get a vendor take back this big with this payment that you negotiated doesn't mean that the lender is going to allow it. I mean, unless you're taking it behind a second mortgage, or you're going with a vendor take back first with no institutional lender, that's different. But if there is a traditional lender in first position, we have to make sure that the debt coverage covers both payments.
Yeah. And I believe the debt coverage ratio, or the DCR, on the VTB in second is higher, right? It's a 1.3, I think, DCR on the VTB in second.
No, not necessarily. No.
Okay.
No.
I guess depends on the lender.
Depends on the building size, and depends on the lender.
Okay. Got it. When it comes to refinancing, let's say you do that CMHC exit, you do a 10-year term, but 5 years down the road, you decide, hey, I want some equity out of this building. What would be some of the options? I believe you can get a second mortgage behind the CMHC first, right?
You can get a second mortgage behind the CMHC first, as long as the lender allows it, and as long as the property can cover both payments.
Okay.
There are options to go and get a CMHC second. However, many lenders do not do it unless the loan amount is $1 million or more.
On the second.
Yes.
Right. Okay. What else do you feel like we should know as, I guess, investors that are going into commercial multifamily on the financing end?
That's really pretty much it. I would also invite investors to download our tool. It's going to be helpful when you're running numbers, and I put together a 1-hour complimentary video on how to use it. It's the DCR calculator. They can download it at streetwisemortgages.com/toolkit. So yeah, just plan your exit, strategize your financing going into the deal, do your as complete appraisal, validate your assumptions, lean on your broker, and be conservative overall. We are in a very volatile rate environment. I have to buffer for volatility when I run the numbers. I'm not running the numbers at a 4.5%. I'm running them at a higher. And yes, it's going to look more conservative, but it protects you, right?
Yeah, for sure. And I think what you were saying earlier about due diligence and all that, I think that's one of the nice things about working with your team, that there is, strategy involved. So if you do have questions, if you're running numbers, you can always reach out to somebody.
Absolutely.
And they'll give you an answer, and your team has the experience to deal with that.
Yes, absolutely. So many investors lean on us when they're evaluating deals. They come to us and say, Dalia, okay, here is the deal that I'm thinking of putting an offer on, or I'm thinking of pursuing. Here are the numbers. Here is my plan for the property. How do I do this? Should I negotiate a vendor take back? Should I, bring a money partner? Like, we're happy to guide you through this and help you figure out the pieces. And especially for investors who are starting out in that space, right? Once you've done it once or twice, you get the gist of it and it becomes clearer. But yeah, many investors lean on us, and you can always email us, and we're happy to support you and guide you.
Yeah. Maybe just, I know we kind of touched on this a little bit, but so you think that moving forward, that this year there may continue to be some rate hikes, but you believe that potentially in 2024 things might change, things might come down a little bit. Would you say that's a fair assessment?
I don't personally believe. I lean on others who are smarter than me, who are daily looking at the rates every single day.
Yeah.
But yes, what goes up eventually has to come down. And we are right now at the peak of the mountain. We're very, very, very close. And we will see it come down. It's not going to be this year. It's likely going to be next year, like you said. The market is expecting it to shift towards Q3, early Q3. So June, July.
Yeah.
But if the data continues to surprise the Bank of Canada and everybody, that may change.
Right. Yeah. We don't know what's going to happen. But just to go back to something we were touching on a little bit earlier, which I forgot to ask you about. But again, for those that have a variable mortgage on a residential property, what would be the process of converting that to a fixed? And if they are looking at converting it to a fixed, would you recommend doing like a 1-year fixed or a 2-year fixed, or just kind of getting your thoughts on that?
So typically, if you want to lock into a fixed term and you're currently on a variable rate, the lender will not let you lock in for a term that is shorter than the remaining term. So let's say you're in a variable rate and you've got 3 years left and you want to convert to a fixed. They're not going to let you lock into a 1-year fixed, right? You're going to have to take a 3 years fixed. Here is my suggestion. So for those investors who are currently on an adjustable rate where they're feeling the pain, knowing there is another probably 50 points coming in by the end of the year, can you absorb it? And if you can, stay the course, because you want to ride down that slide in 2024, okay? And it's not that the rates are going to drop by 200 basis points in 2024. That's not how it works. It happens gradually, 25 and then 25 and then 50, maybe 75 points to 100 for the year, but eventually, over an extended period comes down by 200 points.
Yeah.
So if you're currently on a variable and you can handle another 50 points, stay the course, don't lock in. If you have 1 year left on your variable and you want to, you don't want to, you just want to sleep right now because it's adding pressure, then take a 1-year fix. My recommendation is to take a 1-year fix, because if you lock into a longer term, you're really locking in at the height right now.
Yeah.
And when that improvement starts to happen, you don't want to be locked in here and do not benefit from this reduction in rates. So you either ride the rate cycle down, staying on the variable, or if you're to make a rate decision today, take a 1 year. That takes you to July. No, not July. Where are we now? June. We're right now, June 2023. That takes you to July of next year. So it positions you right into that zone of, when the rates will potentially start to improve.
Yeah. Because there's a big spread between fixed rates right now and variable rates, right?
Yes.
I believe the fixed rate is like somewhere in the under 5% on certain
Yes,
terms.
that's right.
Yeah. So, I mean, if you can lock it in for a year versus a 6.95 variable right now, it might make sense for some people, right?
It may make sense for some people, yes. And it's a numbers game too, right? Does locking involve switching lenders? Because if it involves switching lenders, there are costs that we have to take into consideration and say, okay, given the differential and the cost involved, is it worth your while or not? So we have to look at all of these things.
Case by case,
Yeah.
always, right?
Yeah.
Because then you can potentially re-amortize during that process as well to lower your payment.
Right.
Yeah.
Yes.
Cool. Always love picking your brain. You have a lot of knowledge on this. Is there anything you feel like we missed or anything you want to touch on?
No, I think we've touched on several key topics: the rates, the cash flow pressures, the shift to multifamily, which is what we're seeing right now. All I can tell investors is investing is a numbers game, and at the end of the day, don't just get focused on the rate, right? If the numbers works, the numbers work. And if you're experiencing cash flow pressure right now, your lender may not think of solutions, but there are options, as I mentioned earlier. So we can look at ways to alleviate some of that pressure. And whatever we're going through right now is temporary, right? I've seen the pendulum swing this way and this way. So right now we are really here close to the ceiling, and it will come down. So we all need to figure out what to do to ride the wave. And if it means shifting to an interest-only payment to ride the wave, that's not how it's going to be for the next 25 years. We're just pivoting. I don't like to use pivoting, but the word pivoting is overused, actually. It's we're looking to navigate as the waters change. That's all.
Yeah. That just kind of made me think of one last thing that I want to ask you about. Qualifying for mortgages is much harder now because the rate's a lot higher, especially for people with a larger portfolio. What are your thoughts on getting a blanket mortgage to cover multiple residential properties?
I caution against blanket mortgages. Blanket mortgages may sound like the cool solution right now to problems, but I'll tell you why I am very cautious about blanket mortgages. When things get tougher, okay, you've got, here are the different roads: A lenders, B lenders, private lenders, and commercial. And that's where blanket mortgages come in, right? Commercial financing is what we're referring to, right?
Yeah.
Okay, so A lender is becoming very tight. B lender is becoming tighter. Private, obviously, is private. When things get tighter, we want to see if there is any way we can continue to squeeze money out of the A lane. If it's not the A lane, yes, the B lane is more expensive, but it's still giving you flexibility and control. Commercial, right now, if we do residential deals under commercial is just the term, right? It's how the lenders look at deals. It's based on the debt coverage of the portfolio. But we can actually do 3 duplexes and do them as a 6plex under commercial financing. We've done that. But I would leave it as a last resort. Why? Because once you have that commercial blanket, you are really tying your properties at the hip. You lose that flexibility. That's number one. And now under commercial financing, every year you have to do something called the annual reporting on the portfolio. And potentially your amortization is going to get less than the 30 years to 25 years. So I always like to look beneath that iceberg as to, is this really worth it? And yes, for some investors, absolutely. But it's not the first solution I would jump at as a solution to what's going on right now.
Got it. Okay. Well, thank you for touching on that. Before we finish things off, do you just want to tell people the best way to reach you? And I know you offered that report or that spreadsheet with the DCR calculator.
Yes.
You just want to maybe tell people the best way to get in touch and whatever else you're offering.
Yes, you can reach us at info@streetwisemortgages.com and use that calculator to run your numbers, streetwisemortgages.com/toolkit. We can help you with scaling if you're looking to scale, cash flow issues right now, or stepping into multifamily. My team is incredible. And we've expanded across Canada. We're not just in Ontario, so we're across different provinces right now, and we're here to support you.
Great. Yeah, you guys do a great job. I appreciate you coming by and sharing all this information. And
My pleasure.
I look forward to staying in touch.
Same here.
Thanks for listening to this episode of the Well Off Podcast. If you enjoy the show, then I'd really appreciate if you left us a review on iTunes and let us know your thoughts. In order for us to get a larger audience, it's really important to have reviews, so your support is extremely appreciated. And also, don't forget to share the podcast with your friends and family. Until next time, I'm George Almasri. Have a great day.